I think it's a really great thing to have in the terms. You are going to be married to this person. I know I've said that a few times now, but expectations on how often are you talking to them? When are they showing up to meetings? What sort of reporting do they want from you? And how often do they want that reporting? In this episode, we explore the world of angel funding, where early-stage entrepreneurs gain capital, mentorship, and momentum from investors who believe in their vision. Please subscribe to our podcast to stay updated, and for more information, visit our website at prospirit.com. Also, if you know someone who might enjoy our content, please share our podcast with them to help us grow.
The Let's Get Entrepreneurial podcast is your ultimate launchpad for igniting ideas and skyrocketing your entrepreneurial dreams. Your two hosts will be Professor Gary Palin and serial entrepreneur Ryan Budden.
Hello, Ryan. How are you doing today?
I'm doing brilliantly, as always. What about you, Professor Palin?
Still busy. Ryan, today we're going to talk about a method of financing a venture. It's referred to as angel investors. It's a very common term in entrepreneurship, but anyone external may not understand what it is. Basically, it's an individual investor who provides capital for startups in exchange for equity or convertible debt. They tend to be high net worth individuals who invest their own money. Their motivations very often are obviously financial gain. There's a high risk, high return component to this. Very often they have a passion for entrepreneurship, and not unusually it's a cashed out entrepreneur that's been successful one or two or more times, and they like to stay in the game, but they're not necessarily interested in launching their own. So the passion for entrepreneurship is there, and also there's mentorship opportunities for those individuals. Does that about capture the entity of an individual angel?
I'll just add that they've typically been in your shoes before, so they're able to give guidance from a different perspective than some of the other methods of funding that we're going to do episodes on.
When you say in your shoes, not all of them have done entrepreneurial ventures. Some of them are just high net worth individuals. I prefer to deal with someone that's a cashed out entrepreneur because they tend to add more value and more insights into driving the venture successfully than someone who has made their wealth through other means.
Absolutely. We can't lump them all into one category here.
You typically see angel investors on early stage ventures. They're very often involved in what's referred to as seed funding, and it's often the first outside money into the company. The range, it varies on how much money is invested per deal, but typically you'll see anywhere from $25,000 to $500K.
And $500K would be a very large angel investment. In my experience, they seem to tap out about that $250,000 mark.
Yeah, that $500K, you'll see there'll be 2 or 3 individuals investing. You're not limited to just one angel investing in your startup. But you want to be careful. You don't want 10 or 20 because then that becomes a nightmare.
The angel group, not to muddy the waters of what we're talking about here, but it's become a bigger thing.
Angels have morphed into different types of structures, and we can touch this as we move forward. The return expectation of angels, also something that someone wants to be aware of. It's a high risk, so therefore there's a high reward, as I mentioned before. They are seeking equity and long-term gains. They're not looking to loan the money to you. They want equity position almost always. There might be some exceptions.
And there's always exceptions, but we're talking about the typical exchange with an angel investor, which is they're early on capital to get you going, as you said, seed funding, and they do want a chunk of the business for that.
From a support perspective, in addition to the finances, and I want to backtrack a bit, many people think it's just the money, and it is so much more valuable when you have the right angel that you've chosen that is so much more than the money. There's mentorship there. There's advice, specifically if that person is a cashed out entrepreneur from the same domain that you're playing in. That's very valuable. And also their connections can be an invaluable resource.
I often find that their connections are the most important part of it, even more important than the capital that they're providing.
If their connections have trust in that angel, they're assuming that angel has done their due diligence on your venture. They're more receptive to any type of interactions as a result of that connection.
Yeah, you get much warmer leads.
Also, the decision-making tends to be faster than, say, a venture capital, which we'll be talking about in our next episode. But with an individual angel is what I'm talking about right now. There's no committee required. That person makes the decision.
So it might be less regulated is the negative to that, but the positive is you'll typically get an answer a lot quickly.
Now, just to touch the terms, if someone's not familiar with venture capitalists, that I've mentioned a couple of times, a venture capitalist is a professional fund manager that invests pooled capital from institutions and wealthy individuals. In other words, it's not their money. And then banks is a traditional lender that offers loans and credit lines, but not equity, which is totally different than an angel or a VC.
Totally different. And you have to handle them very differently, and they're typically being brought on at different stages of the business.
We've mentioned angel groups a few times, but that's basically, it can be a formal, can be an informal organization of a number of angel investors who collaborate to evaluate, fund, and mentor startups. They typically pool the resources, share due diligence, and make co-investments. Now, you have a lot of experience with angel groups. Do you mind touching on that?
My experience with angel groups is I do the technical interpretation for pitch days for an angel group here in Nashville. I'll go to the group meetings when companies are coming in to present their ideas and business plans, and I'll help them understand it. What that's given me is a pretty unique insight into how these groups work. It's a bunch of wealthy individuals, like we said, who are angel investors in their own right, who have come together to either make joint decisions or individual decisions. If you're thinking Shark Tank, you are thinking the exact right thing. It is basically a less TV orchestrated Shark Tank that's going on. So sometimes they invest together. A lot of times they invest together, actually. They bring their own risk down and they increase their portfolio, so the number of companies they have in their portfolio. But sometimes if one person's just interested, it can be a single person deal that comes out of it.
Anyone that's interested in angel group, before I'd approach them, I would suggest researching the angel group because, for example, some will only do pre-launch investments. Some are very much focused on a specific area, like they might just do biotech.
That's right. And some have very strict diversification rules. So they can only have one biotech company in their portfolio and only one finance or fintech company in their portfolio. That early reach out or early research is really important so that you're not wasting a lot of your time and effort, in exchange a lot of their time and effort.
Do your research on the angel groups. I would also advise doing your research on the individual angel also. They will do their due diligence, investigating you very deeply. I would suggest doing your due diligence on that individual angel before formally approaching.
Without a doubt. I think it might have been you, actually, that's made the analogy to me a couple times. When you take money from somebody, you're basically getting married to them.
Yes. I don't have a definitive answer. I can argue both sides of the answer to this question. If you're starting out, would you approach an individual angel, look for them first, or would you look at angel groups first?
That's a good question. I think I could argue it both ways as well. I would probably approach individual angels if, and here's the if, I could find one that was well suited. So what's often referred to as smart money, which we just talked about. So someone that has previous experience, they have connections, and they have the funds.
That'd be my initial leaning is individuals, but not necessarily. It also depends on how much money I'm looking for. So if I'm looking for $500K, I might start with an angel group. If I'm looking for just a $25K initial investment, I would not look at an angel group.
Yeah, if it's too low for a group to get involved, you're probably lessening the likelihood that they're going to be interested.
I know you've had some experience with this, and we spoke about this when you were a student of mine. I think you understood it much better after you experienced it. But I had talked to you and I talked to all my students about bad money.
Yes, I have had the unfortunate experience of taking bad money. When you get involved in entrepreneurship, there's this fallacy that exists that money is hard to come by. The longer you're involved in entrepreneurship, the more you find out that there's a lot of money, a lot of places. It's just knowing how to go about getting it. I fell into the trap the first time I ever got outside money. I was flattered that anybody was going to give it to me, and I took the deal before I understood what I was taking, and ended up taking money from a very smart guy, but he had a very different idea of what his involvement was going to look like than I did. And he was a major reason for the downfall of the business. He essentially expected that he had given me this money and then I was just going to be at his beck and call, which oftentimes disrupted me actually running the business that he had paid me to run.
We had spoken about the time commitment when you have an investor in our last episode, which was about bootstrapping, which is one of the reasons both you and I tend to prefer bootstrapping if possible. Each investor adds another level of complexity. In essence, you have to report to them, and that takes your time.
It does. I would encourage you to have a very clear understanding of what that reporting schedule and format is going to be. Finding out that it was weekly and the meetings were roughly a day long from the money that I took was a huge detriment.
Very often it takes a day to prepare for that day-long meeting, and sometimes it takes a few days to recover from that day-long meeting.
It did. So don't fall into that trap. Learn from my lesson. Understand who you're taking money from because you are going to be getting married to them, and take that opportunity to map out what that relationship's going to look like.
Now, what do angel investors, both either individuals or angel groups, what are they looking for in a startup venture?
They're looking for a compelling idea put forwards by the even more important part, a compelling team. So a team that they believe is going to be successful. Ultimately, those two things combine to them getting a return on their money. That typically takes form in a compelling team with a compelling idea.
And when they're looking at their idea, they want to translate that to the marketing opportunity, how the idea concept can seize a viable market opportunity. They're also looking for scalable business models. So they're looking for multiples of their money, not just an interest rate.
Oh, correct. This is way, way too high risk for them to be expecting a 3 to 5% return. They're looking for a 400 to 500% return.
And very often they'll refer to that as 4x or 5x. That 400%, 500% is very often the terms they're speaking in.
That's correct.
We talked about Shark Tank. And very often you'll hear on Shark Tank, how many sales do you have? How many customers do you have? So that's referred to as traction in the business. It validates the business idea. So if you have X number of people that are already buying this, that will get their attention also. The timing on when you go for angel funding is important, because if you do it from concept with no sales, it's much more difficult than if you can come in and say, we've been doing this for a year and we have $1 million in sales.
Without a doubt, being able to say that shows that you have the knowledge and the know-how to execute and continue to grow the business.
When you're presenting to angels, what do you present?
But typically, you're coming with a pitch deck. So an organized presentation. A lot of people use something like Microsoft PowerPoint to do this, although you can use whatever format you want. But it's an organized presentation. So it goes through the idea, the team, the traction, and then what the financing is going to look like.
From the perspective of the financing, also one of the things you want to understand, and very important to understand, are what are the terms that are involved with the deal. Again, you've had experience with that. Do you want to touch on what are the typical types of things that we see in terms?
Terms are essentially negotiation points. What does the money exchange look like? There's obviously a dollar amount. So how much money are you getting? And then what are you giving up for that amount of money? Is it a percentage of the business, which is most typical? Is there an opportunity for you to convert that financing? So if there's another person that comes involved, a VC later on, an angel investor with more money, can you buy that investment back out? If you were the angel and I was a business, we could orchestrate it that you were going to give me $100,000 for 10% of the business. Oftentimes that is set until the sale of the business. I have given you 10% in exchange for 100,000. However, a lot of times you can structure terms so that if another angel comes involved that's giving, say, $1 million, I could buy out your 100,000 to get my 10% back at a rate. So you're going to get a 4x multiple. So I'd give you 400,000, I get my 10% back. That's one of the negotiation points. Another negotiation point that you often see is a board seat or some sort of controlling seat. It's less typical with angels, more typical with VCs that they'll want some controlling seat. But you might add them to your board of mentors or your board of advisors, which is more of an honorary title, but still holds a lot of weight.
The example you gave about they'll invest $100,000 for 10%, that translates to what's be referred to as the valuation. And in that example, that means you're saying the business is worth $1 million. 10% of 1 million is 100,000.
Yes, that's correct.
I also see sometimes in the negotiation points, what are the advisory roles? We touched on that when you were talking about bad money. I'd be very clear on what is the advisory roles, what is the responsibilities and roles of that angel investor. I would put that in the terms if I could.
I think it's a really great thing to have in the terms. You are going to be married to this person. I know I've said that a few times now, but expectations on how often are you talking to them? When are they showing up to meetings? What sort of reporting do they want from you? And how often do they want that reporting are crucial conversations. And oftentimes that can be outlined when you're talking about an advisory board or a mentor board.
Those are just a few examples of negotiation points. We could list hundreds of them, but that's something that someone should research what are typical negotiation points and see which ones are pertinent for you. But the ones we mentioned are very, very typical. There are a number of success stories with companies that have received angel investments. Facebook received angel investments, Uber, Airbnb, Google even received initial angel infusion.
Oh, that's amazing. I didn't know Google did.
Yeah, early on, I believe it was out of Stanford.
I'm not surprised by that at all. A lot of large tech companies that turn into unicorns have an angel investment to get them past that first inflection point.
They can be tremendous success stories, and that seed funding can catapult major companies. Now, what mistakes should you avoid when working with angel investors that you've seen?
The mistakes when you're working with them, so once you've taken the money, oftentimes involve a time crunch situation. You are either spending too much time orchestrating with them or not enough time, which is normally the thing. You've just taken their money and you're not utilizing their connections, you're not utilizing their expertise, and you're not really bringing them on that journey with you. You simply use them for a paycheck, which hopefully, again, you went into this thinking that you were going to get more than just the paycheck.
Another common mistake I see, especially startup entrepreneurs that have never gone through this process, is they overpromise results. And while that may help you obtain the funding early, you pay for that later on down the road.
Yeah, then you're going to get crunched when you don't get those results.
And also giving away too much equity early is a very, very common mistake I see people making.
Early stage ideas are really hard to evaluate. It's difficult when you don't have revenue to get an idea of what something's worth. Oftentimes, in the beginning, you will see people having to give away large chunks of the company for relatively small amounts of money.
The longer you can wait and bootstrap, proof of concept, validate there are customers and sales, you can have a higher valuation. So for the same amount of money, you're giving up less equity.
That's the general idea. That's the hope. That's why people hold on for as long as they can.
Just understanding the nature of angel investment is a common mistake that I see people make. We talked about ignoring the investor fit when we talk about bad money, or thinking that angels are giving you a loan versus equity, just not understanding the concept. Very typical mistakes I see startup entrepreneurs make.
Just not flushing some of these conversations out as much as they should.
In conclusion, any final thoughts on angel investors?
I think we've covered the basics. I just encourage people to take their time with this part and understand that the first person that offers them money is not always the best source of that money.
I would also encourage individuals, before they need infusion from an angel investor, to go to a local entrepreneurship center, local activities involved with entrepreneurs, meet entrepreneurs that have taken angel money, pick their brains, talk to the angel investors, and you get a greater awareness and you create a relationship with them before you need the money. It makes it much easier. And also, I would advise people to look at online angel networks. That's a whole other venue that people can access.
Yes, and there are some quite popular websites that we won't go into, but are very Googleable for people to figure out what that looks like.
Excellent. Well, let's get entrepreneurial.
Let's get entrepreneurial.
We extend our gratitude for your presence and attention. Check out profspirit.com to discover resources and courses designed specifically for innovators like you. Stay on the cutting edge by following us on Spotify, Apple Podcast, YouTube, and other platforms as it is released. Until then, keep the entrepreneurial flame burning.